We're now going to have a look at examples of relevant cash flows. You'll notice that I will put up the full set of slides for this topic, but I'm not going to talk through all of them. There are about 80 and I really don't want to drone on excessively. So I'll look through about the first 20 or 30 of these. And if you have some questions with some of the others, just feel free to ask me. Okay, so let's have a look at some examples of cash flows, talk about what's relevant, talk about what we include and how we do some of these calculations. So we know where we get the cash flows, right? We're looking at relevant cash flows that happen or don't happen because we make a particular decision. And that's going to involve annual cash net inflows. It's going to involve any additional capital expenditure up front in buying assets and investments in working capital. And it's also going to involve what happens at the end of the project. Any sale of an asset with some tax implications, and any recovery of our investment in net working capital. Okay, so let's have a look at a few questions just to help us get our mind around some of these things. If we've got an old machine that we sold for $9,000 and we need to sell it in order to engage in this project, is this relevant? Yes, it is. It is something that changes based on our decision, and it is a cash inflow at the start. What about if the book value of that old machine is $6,000? Is that relevant? No, it's not relevant. At least it's not relevant directly. But it might be relevant for calculating the tax effect and therefore an additional tax inflow or outflow because of the sale of that machine. Purchase price of the new machine is $150,000. Pretty obvious that's a cash outflow at the start. Installation cost, similarly. Selling expenses for the new product per annum, those are going to be part of the net cash flows over the life of the project. What about the cost of market research paid 2 years ago? It costs $700,000 and we can't recover any value from it. Well, that's sunk cost. It's not relevant. No matter what decision we do, that $700,000 doesn't change. It's gone. It's been spent. We can't get any value out of it. So that is not relevant because it is a sunk cost. It will not change based on the decision that we make. Sales of the new product, $450,000 per annum, part of the net cash inflow. Interest paid on debt finance. Remember, we're looking at the investment decision. Financing is incorporated in our cost of capital calculations. So financing cost is not relevant. What about the market value of land on which a new warehouse is to be built to hold the new plant, and its current sale value is $710,000? Do we include this? Yes, we do. Because if the market value of that building is $710,000, it's like cash, right? We can turn it into $710,000 worth of cash. So it's like we've got some cash. But by not turning it into cash and using it for this project, it's like we're making a $710,000 cash investment into this project. So this is a cash outflow at the start. What about depreciation expense? Again, we've talked about this. It's not a cash flow. It's not directly relevant, but it may be relevant for calculating the tax effects of our various cash flows. Now, here's a point I made before. Let's make it again. Just because head office has some expenses which it allocates to your new project does not mean that those expenses are incremental. They may have still been spent anyway. The fact they're reallocating them differently to different plants and different projects does not change the amount that's spent. So allocated head office expenses, if those expenses are going to be incurred anyway, they're not incremental because of the project, they're A, not a cash flow, and B, not relevant. Dividend paid to shareholders, it's a financing issue. We ignore it. Increased tax savings from depreciation. Well, that's going to be a cash inflow as long as we're depreciating the asset, as I already mentioned above up in J. What about lost sales on an existing product? Look, if we're taking on a new product and that involves cannibalizing our old product, then that is part of a cost. It's a reduction in cash inflows we otherwise might have had. So it's like a cash outflow that's going to occur because of this new project. So let's have a look at an example. Change Limited is considering the introduction of a new product which will be in competition with its existing products. The new product will have a life of 10 years. It's going to require an investment in some plant of $1.5 million at the beginning, and that's got a life longer than the product's life cycle. Apologies for the lack of an apostrophe there. So we're going to depreciate it. We depreciate it over 15 years. So at the end, we're going to have a cash flow associated with getting rid of this plant. But for the moment, we're going to worry about the upfront investment and then the depreciation. Okay, so at the end of the project, when the project finishes after 10 years, that plant still has a value of $250,000. We're expecting sales every year to be $950,000 and the cost of goods sold is $500,000. Now, why is that cost of goods sold going to be a cash flow? Because when we sell those goods, we're immediately replacing them with new ones to sell. It's clearly a cash outflow. But at the beginning, we're starting up by making an acquisition working capital. We're investing $350,000 to have a starting level of inventory for sales. And we also need to pay some rent each period, not including cost of goods sold, so it's an additional expense, additional cash outflow each period of $37,000. Okay. The new product will cause a reduction in changes existing product sales, losing some sales on another project, and required rate of return is 12%. Should we go ahead with the project? All right, so let's look at the different sets of cash flows. Firstly, let's look at the cash flows up front. We know that we're basically making two essential investments in this project. We're purchasing the plant and we're purchasing the initial set of inventory to get us going. So our total investment is $1,850. Now, while we've got the plant here, we may as well work out what the depreciation is. It's $100,000 a year. That's going to be relevant for working out our tax effects. Now let's have a look at the cash flows over the life of the project. So we know the sales and we know the cost of goods sold. Remember, this is a cash flow because every time we sell inventory, we replace it with some more. We've got this additional rent. We're losing sales, so that's a reduction in the cash inflow somewhere else of $13,000. So these are all cash flows. Okay, so we've got those. Now, for the meanwhile, we're going to take off the depreciation so we can calculate EBIT. Why? We need that EBIT number in order to work out what our tax effect is, because that's a cash flow. Okay, so given we've got that profit, we're paying some tax on it. Now, why did we take out the depreciation? Because it's not a cash item. We took out the depreciation so we could calculate our tax. And once we've done that, we add back the depreciation because it isn't a cash flow. Right? So we only took it out temporarily to make sure we could calculate tax. Look, what you could do is, if you feel a little bit uncomfortable with doing it that way, you could do it. You could basically say, let's calculate our cash flows. So 950, 500, 37. Sorry about my writing. Minus 13, right? And that's going to give you cash flows. And it's somewhere off here on the side. Let's change color for a moment. Somewhere off on the side, you do your tax calculations. So you've got 950 coming in, you've got 500 going out, you've got 37 going out, you've got 13 going out, and in doing your tax return, you also get to include your 100. So you get to tell your tax man that your profit is 300. You use that to calculate your tax, which is minus 90, and you know that that tax is a cash flow. So once you've done that calculation on the side, you can bring that 90 across and say, well, here it is as another cash flow. And since you didn't take off the depreciation here, you don't need to add it back again here. And so you're still going to get the same operating cash flow of 310. Okay, so we've got the cash flows. We've got the cash flows during the life of the project. So now let's look at the cash flows at the end. At the end, remember, we're going to sell the plant at $250,000. Now, when we come around to selling it, remember what our depreciation was. Our depreciation was $100,000 a year. We were going to depreciate it over 15 years. However, we sell the plant 10 years in. So we've only depreciated it down by $1 million. So at the time we sell it, it's got a book value in our records, or rather in the tax version of our records, of $500,000. So when we sell it, yes, there is this cash flow of $250,000, but there's a tax effect. It's recorded at $500. We sell it for $250. So essentially, we've got an extra loss there that reduces our tax. So we multiply that by the tax rate. There's a reduction in tax. In other words, like an extra cash inflow. So the total cash inflow will be the sale plus the reduction in tax from the asset, 325. And of course, we've got the recovery of inventory. We run down our last inventory, but we don't replace it. So there's 300. So the terminal inflow, the inflow at the end of the life of the project, is 675. Recovering the asset and recovering our investment in working capital. Okay, so we've got that. So we've got the cash flow at the start of minus 1850, cash flow over the life, 310 each year, cash flow at the end, 675 at the end. Calculate the present value at 12%, and we've used the annuity formula there for the 310 since it's a repeated amount, but you could calculate them individually if you want. And what do we get? 118,901. It's positive. Pretty small compared to the investment. Well, no. Anyway, it's positive, so we take the project. Okay, summary spreadsheet, just to see how those cash flows are laid out. Notice what we've got here is we've included the depreciation as a deduction to help us work out EBIT, which is used to calculate tax. Then once we've used that information of that, we add the depreciation back again. So the depreciation isn't really a cash flow. It's there to help us do our tax calculation. Okay, and I've already talked about that. So this basically happens for, I've only got a few of the years in here, but years 2 to 9. Here's the original investment in the plant and the working capital, which is inventory. Here's our sale of the asset with the tax effect and the inventory coming back in. Okay, so there's an example of picking up what costs are relevant, thinking through it, thinking through what the effects are, thinking through the effects of depreciation, both on the tax paid during the life of the project and the tax effect of any disposal of the asset or the project at the end. Okay, so a few slightly more basic questions, I guess, just to think about these issues a little bit more. What's a sunk cost? Is it expenditure that occurs after the decision for the project under consideration? Is it expenditure that occurs prior to the decision for the project under consideration with no commercial value? Is it a relevant cost? Is it a joint cost or benefit? Whatever that means. Clearly it's B, right? It's something that has happened that will not change under the decision. And as a consequence, it is irrelevant for making the decision. Okay, what about if a capital expenditure proposal results in a decrease in the amount of inventory held? Why would this happen? This might happen because our capital expenditure proposal is actually something that helps us be more efficient with our inventory management. Have a think about this. Remember that any movement in inventory at the outset is like an investment in working capital. In this case, we're actually getting something back from working capital. So the investment is the amount of money we put out to make this capital expenditure, less any cash we release from our investment in inventory, in working capital. Let's think about interest. Interest expense incurred in financing a capital expenditure should be. The answer, of course, is C. Remember that we're excluding financing costs. Those are incorporated in the cost of capital, which is the discount rate we're using for calculating net present value. So we ignore financing aspects. Okay, so what's a relevant cash flow? A relevant cash flow is a cash flow that's affected by the decision. If the cash flow isn't affected by the decision, then it's not relevant to making the decision. If you make the decision, the cash flow occurs. If you don't make the decision, the cash flow occurs. It's not affected by the decision. So it's totally irrelevant. Here's a fill in the words one for you. What about if we get to the end of the project's life and the book value for the asset exceeds the salvage value? What does that mean? That means we haven't depreciated enough, right? Have a think about this. Yeah, we took too little depreciation. We didn't depreciate enough, and so essentially there's an additional loss or depreciation at the end. By the way, spelling error throughout. Okay. One more example. MIS is a manufacturer of computer peripherals. They've spent $50,000 developing a new keyboard, and now they're going to launch it. In order to launch it, they need to invest in new machinery worth $400,000, which is going to be in their current factory. So we don't need to get or rent another factory. And the machine's going to be written off for accounting purposes over 10 years, and they're financing it by a loan, which has got an interest rate of 12%. Guess what? Both of those last two things are going to be irrelevant. The reason the first one is irrelevant is what matters for calculating the tax effect is not the accounting depreciation under accounting rules, but depreciation under tax rules. So under tax rules, this machine is depreciated over 5 years. Okay, so we're going to calculate depreciation according to the depreciation the tax office allows us to put on the tax return. The sales, we've got various sales numbers for each of the years. At the end of the life of the machine's going to be scrapped. It's still going to have some value because remember it had a 5-year life, but the project's going to last for 4 years. So it's going to have 50,000 scrap value. By the way, this is a comma which was missing there at the outset. We've got material costs that we've got to incur each year as part of production, and also some labour costs. Now, in addition to that, we're going to incur some additional fixed factory overheads, e.g. electricity, and it's going to be necessary to increase inventory holdings of raw materials, not by, but to. So in order to be able to do our manufacture, we need to have a certain amount of raw materials on hand, and we've decided that 6% of following year sales is what we need on hand at the start of the year to get us going. The company requires a rate of return of 15%, tax rate is 30%. So what's the net present value, and should we do the project? If you want, have a go at this yourself and then come back and we'll work through it. Okay, so up front, let's look at the cash flow at the start. We've basically got two types of investments at the beginning. The first investment is buying a machine, $400,000, and that's obvious, I think, from the question. The second is a little bit more subtle. We need to be carrying 6% of our following period's sales in inventory in order to be able to start our production. So we're expecting sales in the first year to be 400,000. So up front, if you like, at date 0, we need to make sure that we are carrying 6% of 400,000 in inventory. So effectively, we're making a total net investment up front of minus 424. Now, just looking at the depreciation of that machine for tax purposes, it's going to depreciate 80,000 per year because we're allowed to depreciate it over 5 years. So here's a table that brings together all of the cash flows. We've got the sales, they were given in the question. These are all the cash flows except for the termination and the initiation of the project. We've got labour, we've got fixed overhead. Now, we've got depreciation. It's not a cash flow, but we're sticking it in here so we can come up with an EBIT number that allows us to calculate the tax cash flow. And once we've used that EBIT number, including depreciation, to calculate our tax cash flow, our tax cash outflow, we add back the depreciation because we shouldn't have taken that off. Really, for cash flow purposes, it's not a cash flow itself. It simply helps us to calculate the tax effect. Now, this one you might have missed if you'd had a go at it, but change in net working capital. Remember how up front we invested $24,000 in inventory to get us started, and we're told that we want to make sure that we're carrying 6% of inventory, 6% of the next period's sales, the anticipated next period's sales in inventory at the start of the year. So if we take 6% of 420 and take off what we've already got in inventory, which is the 24,000 we put in the beginning, we've got to invest an additional 1.2 in both years 1 and 2. Our sales don't change between years 3 and 4. There's no additional investment at the end of year 3. And at the end, when we wrap up the project, all the funds from the inventory get released and come back to us. So there are our net cash flows over the life of the project. Okay, last thing we need to look at are cash flows at the end. Now remember, we're told that we can sell that machine for 50,000. However, remember what the depreciation was. We bought this asset for 400, we were depreciating it 80 a year. So after 4 years, we've depreciated it by 320. So it's gone from 400 down by 320 down to 80. So its book value is 80, but we're selling it for 50. That means that we've got a loss, and that loss is going to give us a tax deduction. So that is an additional tax inflow. It reduces tax paid elsewhere. In other words, it's like an inflow. So there's the total inflow at the end. Okay, and that's where the book value comes from, just for reference. Okay, so now we can calculate net present value. We've got all of those different cash flows at the different times. Calculate net present value. We're discounting that at our hurdle rate. We come up with 119,000. It's positive. Yay, go ahead with the project. Okay, notice we haven't done anything with the loan or the variable interest rate. We're not including the financing. This loan is financing the asset, but we've got other sources that are financing the other parts, like the investment in inventory. We have somewhere behind all of this a calculation of weighted average cost of capital that's led us to say, look, the hurdle rate that matters is 15%. Oh, and by the way, in case you're a little bit worried about those working capital changes, here are the calculations. Okay, so the rest of the problems I'll leave up. I'll put up with the slides. I'm not going to bore you with my voice by talking you through those, but please, I encourage you to have a look through those and ask any questions if you have them. That's all for this topic.